Today's guest has helped real estate investors offset over $200 million in tax liabilities. Yes, you did hear that right. That's the powerful strategy of cost segregation. But that's just the tip of the iceberg. He's a magnetic force behind Tuesday Connections, a weekly real estate networking event. And he's become a familiar face on podcasts across the country. And thanks to his deep knowledge and relentless drive to connect and add value. Whether it's finding equity, securing off market deals, or just making the right introductions, he's always looking to help others win. Isaac Weinberg, welcome to the show.
Thank you. Thank you for the kind introduction, Ahmad. You're a good man, and I'm excited to be doing this today. Just help out some folks out there, learn more, and strive for more.
I can imagine this is going to be like a master class because after researching you, I can tell your deep expertise. And before we dive into your incredible journey and tax strategies that help your clients save millions, what drove you to real estate cost segregation? What was that first initial spark?
I love that question. Growing up, I always had that personality and mentality of working hard. Um, I didn't say no when things seemed bleak, and what do I do now? I always strived, and I had something in my mind to do it, whether it was becoming the best barber in the school. I made sure I didn't sleep till that happened. Whatever it took for that to happen, that's something that I strive to do. And obviously, with God's help, He made it happen. And when I ventured into the work world, so I think the traditional path would have led me either to syndicate some deals or become a commercial mortgage broker. And I was speaking to some folks in the space that have done this before me. And somebody mentioned to me, "Hey, Isaac, why don't you try out cost segregation?" I looked into it, and initially I'm like, no, it's a low ticket item. You don't make so much money per transaction. I'm a relationship guy. I'm going to do something that is a higher ticket item. After speaking to many, many folks, successful folks in the space, he said, "Hey, Isaac, cost seg, you don't have so many cost seg guys out there. There's 30 debt brokers for every owner. It's a niche product, but most importantly, it's an educational item. It's something that talked to me more than anything when it comes to so many different vendor items. So it's really cookie cutter to a certain extent. Cost segregation is so niche and so detailed and so nuanced. And I love educating and being in the cost seg world. That's allowed me that opportunity to go to events, speak by meetups, speak on podcasts, and explain people how you could have the same property, but for you it means A, and for you it means so. Between the educational aspect and between just the fact that you don't have a crazy amount of cost seg people out there, I was able to create a brand for myself again with God's help and make connections and pick up clients. Some of them big time guys, and I think people see in me a genuine guy. I'm an authentic person. What I tell you is what you're gonna get. There's not going to be any hidden fees or surprises at the end. And that's it. So I do every single day in, day out. Try to bring that authentic Isaac to the table. And I think people appreciate that and just keep educating people and put in an honest day's worth of work and go home and do it again.
I love it. And I love the education bit. I definitely connect on that. Was there a particular deal or client that cost seg really clicked for you? Like this was where you wanted to make a massive impact?
For sure. I remember early on in my career, there was a sophisticated owner. And I say sophisticated, not just a big owner. He knew his beans. He knew what was going on. And he was honest with me when I started sharing about this cost seg idea. And he's like, "Hey, I looked into it. I thought it wouldn't make sense for me." And I broke it down for him exactly, even though it didn't make sense because he wasn't getting hit with the tax liability. A certain investor was, and he could leverage the depreciation to win over that investor. And he was completely floored by it. And ultimately, I believe that the reason why that investor came in was because of the depreciation. Obviously, the deal had to pencil, which it did, but many deals pencil. But this one had a crazy amount of depreciation, a big depreciation play. I taught him how to use it. And ultimately, he was able to pick up this investor. And it just, that pushed me more, aside from the fact that it's nice to win a deal. It pushed me more like, hey, like when it comes to title insurance, and it comes to debt brokerage, and it comes to anything, you need it. No matter if you understand it, you don't understand it. That's required when you buy 123 Main Street needs all these components. But cost segregation, you don't need to do it for the deal to close. And for me to be able to educate this guy and explain to him how to leverage it and him to win over that investor was huge for me. Like it actually felt good. I had a friend that was in cash advance, and I'm not knocking out the whole cash advance industry. And he was making a lot of money and he stopped doing it solely because like he felt bad doing it. People needed the money and whatever, but the idea is that he felt bad doing it. I felt good about the fact that this guy was able to get equity for his deal because of that advice that I gave him. So yeah, it's a side benefit, and obviously I wouldn't be in this if I was doing it for free. But when you do something that you enjoy, when you do something that actually is helping people, it adds that much more satisfaction and just overall good feelings. That is just there's nothing like it. It's just it's exciting.
And you've become a real voice in the space. Like you've done LinkedIn, you're very big at events, podcasting. For people who are hearing cost segregation for the first time or have only heard like CogSeg thrown around, can you explain it in plain English? And then why should real estate investors care about cost seg?
Absolutely. Very, very important question. So I always start off with a parable. I'm out, I see you in the street, and you say, "Hey, Isaac, so good to see you." I'm like, "Yeah, likewise." Isaac, do you remember 3 years ago you borrowed $100 from me? You never paid me back. I'm like, "Oh my gosh, you're right. How would you like your money? Would you rather $10 a year for 10 years? Or would you rather $30 year one, $70 over the following 9 years?" Of course, you're going to say $30 year one. Let me take as much money as possible year one. I don't know, buy some pencils on Amazon. In years two, three, four, and five. And what you're doing is you're using those extra depreciation dollars to offset your, to give it to your investors, whatever it may be. And now you have more money in your pocket. And now that you have more capital in your pocket because you didn't pay that to the IRS, you're more well capitalized to buy a new property. What's my ROI on the new property that I'm buying that I wouldn't have been able to buy if I didn't have these tax deductions? So the idea is that cost segregation is depreciation on steroids. Essentially, what you're doing is instead of taking all your depreciation over time, you're cutting off a little bit of each year and you're front loading it to earlier years. Depreciation that you would have gotten anyways. What I'm doing is I'm giving you more money today, as opposed to, and a little less over time, as opposed to it being divided equally. It's strictly a time value money play. That's what it is. And we call it as an interest-free loan minus the cost you're going to pay for the study. I'll just add in, many people say, I don't get this. The reason why we're in real estate is because properties appreciate, they go up in value. How in the world are we getting benefits as if it's going down in value? And the answer is that there is no real answer, but I'll take it when I get it. And the government decided that properties have a depreciation market value in terms of every property has a lifespan, and even though the property is going up in value a few percent a year, whatever it may be, you're going to get losses on your property, and that's what you don't have in the stock market. Stocks appreciate, maybe not right now with the tariffs, but stocks appreciate. Stocks don't you don't get depreciation as well. As opposed to real estate, you get appreciation and depreciation.
That's why I love the depreciation on steroids analogy because it really is it's not cheating the system. It's not a loophole. It's not like doing some shady things. It's just taking your depreciation and lump summing it into the first years. And you said it, I love what you just mentioned because a lot of people now see real estate as a more benefit. But in the past few years, people are like, why would I invest in real estate when I can just get 30% in the stock market or 25% in the stock market? And you're right. It's not, you don't invest in real estate just because of appreciation. You invest it because appreciated cash flow and the tax. And the tax is one, I think, one of the most common, perhaps less known values or perhaps benefits of owning
For
real
sure.
estate.
For sure.
What are other misconceptions you hear all the time about cost seg? What do most people get wrong?
That's a great question. A lot of things. I would say the number one thing that people get wrong is they think that once you bought a property and you started taking regular straight line depreciation, we can't go back and fix that. Let's say somebody bought a property in 2021 and they just found out about cost seg right now. They can actually go back retroactively and do a cost seg on that property and front load that depreciation to the current tax year. You do not have to amend your taxes. So no need to amend your taxes. We could go back. You were taking straight line. We can grab all the accelerated benefits and then turn it back the next year back to straight line. I have that all the time. Somebody gets referred to me for costs. They're like, "Hey, Isaac, we didn't know about this, and we do it on that property." I'm like, "By the way, any other properties you have?" "Yeah, we purchased 5 of them in 2022." "You could do it." "Okay, I didn't know that." So that's number one. Number two, uh, there are ways, not every case, not every scenario, there are ways to specially allocate depreciation. So that means if, let's say, you want one investor to get more than the other. Let's say one investor is a non-real estate professional, so he can't really benefit from the cost. Maybe I could give it over to another investor, entice him to write a larger check for the deal. So a lot of people, even sophisticated owners, don't know that this is possible. Again, you got to structure the OA a certain way, but it is possible. Another thing I'd say is that um, a lot of owners think that cost segregation is only relevant for certain types of assets, multifamily. You could do a cost seg on any type of asset as long as it's an investment property. So as long as you're collecting some sort of rent or you have a business that's working out of that building, you can do it. You could do a cost seg. You might get less. An industrial property is going to get less than multifamily just because it's hollow inside. So there's less non-structural components as opposed to multifamily. You got cabinetry, flooring, chandeliers. There's just more components to take, but that doesn't mean you shouldn't look at it. I always tell folks, just have the conversation. Even if that results in you not doing it, learn it. And I think the biggest mistake is not something particular, it's just in general that people view cost seg as dessert. And this is a new type of, I guess, my new way of saying things these days. You look at it as you're on a steakhouse and this is the dessert. Dessert is great. It's always great, but I don't look at it as I don't look at costing anymore as dessert. I don't look at it as the actual entree. It's not the steak, but it's a great appetizer. Meaning to say, if you leverage it the right way, you can really get equity for your deal. You can really do a lot of things with the cost seg. There are ways to channel. Let's say you own a deal. Yes, each deal is in its own LLC, but there are ways to channel into your personal income. There are ways to make your wife or a spouse into a real estate professional, use their status and file jointly to offset your own income. There's so many nuances. I had a guy who called me yesterday. I did a nursing home facility for him. And he's like, how come I got more 2 years ago on a property that I did with you than I'm getting today? Today's property is worth more. I bought it for more. And I told him, hey, just a basic answer that we're holding by 40% bonus. And back then in 2022, it was 2023. It was 80% bonus. It's not just a regular item, cookie cutter. You get your bottle of water and you go home. Every single thing makes a difference. How many partners was it ticks? So I always tell folks, no matter who you are, you could be an Airbnb owner, you could be a multi-billion-dollar owner, have the conversation. Because I just met at a hotel event, a very, very prominent hospitality firm. And they were floored when they found out from me that they could specially allocate depreciation. And they're like, hey, we want to have a call. And we're talking about people that own hundreds of hotels. So my point is that just have the conversation and recognize it's not just dessert. It's an important item that if you play it right, it actually could change the dynamic of a deal. That's the advice I would
I
give.
see it. I agree with you. It's not dessert. It's not like take it or leave it. It's more when I hear you speak, I feel it's like the NBA of real estate investing. You know, anybody could buy a house and rent it and collect checks. Like anybody could do that. That's like anybody going to the park and throwing the ball. But to get to the level of the ultimate sophistication, you have to think about the strategy that you're going to buy, the equity, the capital stack, entry point, exit point, who's going to like what type of funding, if you're going to have investors or not, who's going to be your LP, all that stuff.
Exactly.
But your sophistication comes not only in the sponsorship, but also your tax incentives.
100%.
And I think what you're saying is that tax incentives, or I agree with you, tax incentives can make or break deals if you don't know what you're doing.
100%. 1,000%. And I've seen it. I've seen it.
Can you walk us through what a typical cost seg process looks like from like the first phone call to actually seeing results on paper?
Absolutely. I like that. So, and I get this question, by the way, every single time. So I like that.
I'm sorry, I always try to go to the questions that people don't do, but
No, 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 no.
this one's a critical
The
one.
point that by the way, you're great. And the point I was making was that it's an important question. People like to know this, and not so much on podcasts. I meant when I get calls from people, they want to know what the process looks like. So if you closed on the property already, and that's when we're speaking. Generally, the way it works is you send me the details, the closing doc. I pull from it the address, the closing date, purchase price. We have CoStar. We have all the back office data that we need. If you have an OM, we'll look at your OM. We'll give a projection. Usually it's more conservative. What we think we could get, we'll give a price. We'll show you our process, all our terms and conditions. The client signs, God willing, and then we come down to the property either physically, virtually, depending on the situation, depending on his preference. Once that's completed, the property tour is completed, then it goes back on the conveyor belt, let's call it that, to our engineering team. They have to do their thing and really go through every single line item. Then our CPA team reviews it. I think our legal team also reviews it together with our CPAs. Then we sign off on the study, and then we send the draft report to the client. He reviews it together with himself, his partners, and his CPA. He gives his approval. He makes final payment. We send him the final study. That's how the process works. It takes anywhere from 4 to 6 weeks. I would say a total of maybe a couple hours of his time, start to finish, on his end, on the buyer's end, on the client's end. I always like to push a little further as follows. I like to come in way before. So especially with syndicators, you're syndicating a 200 unit deal for $15 million. Isaac, I'm looking at this property, or Isaac, I just went under contract in this property. How much could I get back in depreciation? I'll look at it. If you ever have an investor call, I'm happy to get on per $100,000. This is what you'll get back. And then obviously once it comes to closing, God willing, we end up engaging. So with my clients, even if clients come to me they refer to me for after they close the property. Moving forward, I always like to give off that I guess service to my guys that, hey, I'm not going to just do it after you close the property. I'm happy to give you back of the napkin or even actual real proposals so you can actually highlight to your investors exactly what they're getting back, and you can know for yourself in terms of you want to go ahead and put down a better offer on this deal. Maybe you have more maneuverability because you're going to get X amount of dollars in depreciation. So try to come in way before. We try to make it as seamless as possible. I actually just got an email today. I don't get these emails every single day. I want to read you this email. Email goes as follows. Great. I love the seamless process. Great work by the team. I will be back soon with other properties. That's an email that I strive to get from a client. We try to make it as seamless as possible. Not too many emails. Obviously, if you don't pay your bills, we're gonna harass you. We can't send you your study till we get paid. But I like it. We have a good system. Thank God.
And do you think, how many sponsors do you think are not taking advantage of this? Is it kind of common, or do you think that a lot of people are still like, amateurs?
Great question. So I would say, out of the 100% of people that buy properties, say, let's say you take 100 syndicators, right? So out of the 100, let's say 10 of them, it's not relevant. They're selling the property too fast. They have international investors that are not going to get with US taxes. So you're down to 90. Out of the 90 that are applicable, I would say 65 to 75% of them, 65 to 75 of those folks are doing it. The other 15, 20%, the other 15 to 25% are just not aware and are misconcepted about it, for sure.
That's an excellent question for anybody that's looking to invest into real estate. What is your cost seg strategy? Have you done this? Because if you're saying that 25% of people, 1 in 4, are not aware about taxes, to me, that's a big red flag, and an easy way to say, who should I work with and who shouldn't I work?
Absolutely. Absolutely. And again, back to what I said earlier, just have the conversation. Every CPA should be telling their clients if they're buying real estate that they should have the conversation. Not that they should have to sign. Have the conversation. Maybe it makes sense. Maybe it doesn't. Let's walk it through. A CPA's job is to tell your client, go look at a cost seg study. Speak to a cost seg guy. There's no excuse for that. If you're an owner, don't just brush it off. This is something that could save you big time.
Can you tell us about a project or a client experience that you feel proud of that really stand out to your value proposition?
Absolutely. It really highlights exactly what I was just saying. I was dealing with a hotel client that was fighting me. He was talking to me, but he was fighting me. He's like, "We don't need this. We don't need this. We're good. We're good." And I said, "Hey, I'm not asking you to sign anything. Let me look at your docs. Let me look at your docs. Let me see if there's any meat being left on the bone." I think one of the things he was trying to say was that our accountants are already doing it. It's a classic answer. Meanwhile, 99% of accountants are not doing it. They're taking straight line. They're not taking accelerated. And I looked at his docs, and we found, I think it was over $3 million more in depreciation, which ultimately ended up saving him over $1 million in real time cash. And for me, that story is like number one because that's a classic case where he was fighting me that it doesn't make sense. Like, stop bothering me. And I said, I'm not asking you to sign. I want to see your doc. I want to see, is there something being left on the bone? And that satisfaction of, like, when he came back and said, Isaac, like, thank you for pushing me. Like, I didn't realize how valuable this is. I'm going to be doing every single property. So and there's so many stories, but like just pushing somebody to help them understand the value of this is something that's like dear to my heart. I was speaking to somebody a few months ago and I told him, I said, if you think the reason why I'm pushing you is because I want to get you a deal and I want to get the commission off of it, I said, don't even use me. I'll give you a name of another car sale guy. Do it for yourself because you're going to be saving yourself hundreds of thousands of dollars. I said, don't use me. I have no relevance anymore. For yourself, for your investors. Everybody talks about, I want to give my investors the highest return. You really want to give your investors the highest return? Give them depreciation. They didn't ask for it. Give them depreciation just because they're good guys, but on top of it, because you give them more depreciation, they're going to have more losses. They're going to pay less the taxes. They'll have be more well capitalized to invest with you on your next deal as well. So the idea is just have the conversation, learn about it. There are scenarios where it doesn't make sense. If you're selling the property within a year or year and a half, generally it doesn't make sense to do because of recapture. You get hit with the same taxes that you got out of. If you have no tax liabilities, you don't have any positive NOI, you have international investors, or you have U.S. investors who are not going to benefit from costing because they're not real estate professionals, it won't make sense. Have the conversation.
I'm gonna I'm gonna highlight have the conversation because I think
That's
it
not that's I coined that. That's just like I've been saying this for years. Have the conversation.
and I think it's a what I get from this is also a due diligence study. Like it's just, having the conversation gives you the extra set of eyes. You might even see things that are like, hey, this stinks. Not even as a cost seg study, you can be like, this doesn't make sense in a whole rounded way. Or we can increase, like you said, you save someone $1 million hard cash. That's enormous. When you're talking to clients or educating your audience, how do you guide them through that complex investment decisions, especially the ones that are like unfamiliar or perhaps risk?
So it's really case by case. Every single scenario is different. Like I said earlier, in the pod, that you could have guys with the same exact properties, but for one it can make sense, for one it can't make sense. So I'll start asking them about real estate professional status. Is this your main job? Is this not your main job? Is your spouse working? Maybe if your spouse is not working, we can make her into a real estate professional. Are you taxable? Are you not taxable? Are you planning on selling right? I'll ask them all the basic 10 questions. And after that, I get a real look at the situation. And then I could actually tell them, hey, it makes sense to run a proposal here. Once we get the proposal back, walk them through. Do the write-offs justify the amount you're going to pay for the study? Maybe it doesn't make sense. Maybe there's just not enough write-off. It's an industrial warehouse that you purchased for $400,000. It's only 40% bonus. You're only going to get a $30,000 deduction. You're not on a high income tax bracket, so you're not paying a lot. You're not really saving when you have a $30,000 deduction. Maybe you're saving 7 grand, but you're going to pay 5 grand for the study. You really save 2,000. So I'll go through. It's literally like a calculator to a certain extent. Like sometimes you'll end up in the negative, so it doesn't make sense. But if you're going to end up in the positive, it does make sense. So there's so many different questions that really get me to a place and get them to a place of an understanding of, hey, does it make sense or it does not make sense? There's no two situations alike. You know what I mean? You could have people that live next door to each other and their grass is growing. It's like, okay, you need to cut the grass. There's no way around it. We need to say what you see is what you get. The grass is growing, you cut it. But him, oh, I have a high tax bill. You got to cut the grass, right? But I'm not a real estate professional. So I won't, even if I go ahead and do a cost seg, I won't be able to offset my tax liability, even though I have a high tax bill. So there's no point in cutting the grass. Whatever parables and ideas and metaphors you want to give, the idea is that no two situations are alike. And that's why each one is curated and perfectly perfected for each individual client. And that's why it's important, whether it's me or somebody else, to have somebody who really knows the cost seg idea inside out and actually could work with you one on one to decide with you and help you understand whether it makes sense or not.
It's a critical point because I believe one of the biggest misconceptions about cost seg is that you can always apply it or that it's easy to understand. It's like, oh, you just take all your purchases or capex and just depreciate it on the first year. And I think it's kind of waving a flag to the IRS to come and look at what the hell you're doing.
Exactly.
I like your point of like every every decision, every opportunity is unique. Could you walk us through what are like the key factors in your decision making before you say, "Oh, this is we should or we shouldn't"?
Absolutely. First of all, that you're a real estate professional. If you're not a real estate professional, you could have all the depreciation in the world. You won't be able to use it against your active income. You only can use it against your passive income. The other main important point is that you're holding onto the property for at least a year, at least one tax year, because then you get to kick the bucket down the road by a little bit. If you're not holding on to it for just one tax year, what's going to happen is that by the time you actually end up getting usage out of the extra capital you have in your pocket, the depreciation recapture is going to come back to you, and you're going to have to pay it back just like that. So there's no point. So I'll find out if it's a long term hold. It doesn't have to be a long term hold, but like I would say a year and a half or more. Um, Rep status, I would say that you actually are taxable. I could get you depreciation, but if you're not paying any taxes anyways because you didn't make any money that year, what are you using it against, right? Is your property cash flowing? If it's cash flowing, great, we'll offset it. If it's not cash flowing, there's no point. Your investors, even if you can benefit from it, but you only have 10% in the property because it's a syndication. So before you refi and before you 30% kicked in, then if most of them cannot benefit from it, maybe there's no point. So really gathering all these details makes a lot of sense. Again, what type of property is it? Are you going to get a nice amount of depreciation? That there's going to be at least a $10,000 swing between the amount you're going to pay for the study and the amount that you're saving. If you're going to save 7 grand, but you're going to pay 5,000 for the study, ultimately you save 2 grand. It's not worth the hassle of the whole thing. But is there a solid close to that $10,000 or above differentiation between the cost of the study and the amount you'll be saving? And just keeping that money in your account, you plan on actually investing it. If you're going to invest it, obviously it's worth it. If you're not going to do anything with it, then why have that extra money in your account? Generally, when it comes to the more sophisticated owners, syndicators, it's an easier conversation in terms of the benefits. When it comes to smaller owners, it's a lot more complicated. But again, because in one day, I could deal with a $200,000 Airbnb client. I could deal with an $80 million multifamily client in terms of $80 million purchase. I could deal with a portfolio of 10 buildings, 10 hotel buildings for $200 million. And each guy needs to be talked to a different way because there's different languages when it comes to hotels and multifamily and real estate professional status. So again, it's like each one has to be individually. Think about a barber, right? So one time the first guy sits down in the chair, he's like a skinny. He wants literally just cut the whole thing off, zero, and leave. I don't know, make your lines, all the cool stuff. And then the other guy just like shave me bald. The other guy's like, I need this big afro. Right? Every guy needs something else. It's not a cookie cutter, just boom, boom, boom. It's the same idea.
And obviously, you are an expert, and you know your A to Z's. What was the hardest thing to learn for you on cost seg? Or what was like the hardest thing or more surprising thing that you're like, wow, I never even thought of this.
I never liked the whole CPA business. It's just like you have to sit by a desk and really learn the code. And there are certain codes that you have to be able to, I guess, implement and they really lay over and they roll over each other. So just learning those details, whether it's with ticks, that's a common, or just basic ideas of land allocations and how they work. And just certain things. There's REITs that don't benefit from cost seg, most of them because they're nonprofit. And sometimes, let's say I dealt yesterday with a post office. So a guy had a bunch of post office, but there's a certain rule. If you're renting it out to a post office, you can't really benefit from it. You can't take bonus depreciation. So all the nuances and details, something that like I wasn't like crazy like used to, because obviously doing certain things in life you get used to detail, but like this was so detailed down to the most like minute detail. I think learning that was a challenge, but ultimately I like challenges and I learned from that. But every day I learned something new because it's such a complex topic. Every client has a different. You get it from tech to opportunity zones to historical tax credits, and there's so much to learn, and I like learning. I think it's just the daily grind of learning how to deal with clients, who not to be rough, not rough, who to be persuasive with, and to push them a little more, who to lay back on, uh, who whatever. There's so many different situations with the tax code, but learning that has been fun, challenging, and rewarding.
And that's why you need to have the call because
Yeah, have the conversation.
have the
Have the
conversation.
conversation.
What trends do you see shaping the real estate or tax strategy world in the next 5 years? years?
I think people are becoming more aware and they are leveraging it. Obviously, multifamily is down right now. I definitely think that things are going to pick up. It has to. What goes down goes up. What goes up goes down. These things just happen. It's the way of the world. Thank God cost seg is something relevant to all asset classes, and I get to deal with folks in the hospitality arena of storage, industrial, multifamily, single family. Uh, so I have a lot to say about a lot of different industries, but in terms of just the market itself, I think things will pick up as people become more secure. Maybe when the tariffs like subside and people start getting used to just a certain way of doing things. In terms of taxes, I don't know. Income tax in general is a killer for people, but I wouldn't have a job if there was no income tax. I'm happy for them to wipe away income tax and I'll go sell flooring or go sell, I don't know, property and casualty insurance. But the idea is that let's bring down income tax, whether it's through cost seg or whether it's through finding other ways of subsidizing the government's, not subsidizing, but by supplementing the government's overhead. But I think people are becoming more well aware, and I think that's very, very important. And I'm excited. I'm excited what I see.
Working with different types of sponsors of different types of product types and perhaps different types of investment strategies, where do you see the smartest capital? Is there one that you can be like, oh, these are the most cunning, or there's
Right.
just all of them are smart and there's a lot of tourists as well across the
I would
board?
say first and foremost, more than the asset class, but the sponsor. If you have 10 people to potentially invest with, nine of them are guys that like they don't have such a good track record, and the other guys in a higher risk asset class. Let's say, let's call it retail hotels. It's a drop higher risk, but at the same time, he's more respectable and has a respectable track record. Invest with them. That's number one. Number two, if you have two guys, one guy is in a higher risk asset class and one guy's in a lower risk asset class, and they're both respectable. Listen, you can't go wrong with multifamily. I shouldn't say that. You could go wrong. People took out bridge loans and people screwed up badly and people's equity was wiped out. But I think multifamily, if done right, is probably the most stable. But again, it's the higher risk, higher return. Hotels, retail, certain asset classes is a drop riskier, and that's why they trade at higher cap rates. And but ultimately you could get a higher return. So it really depends how risky you want to be. But yeah, listen, anything these days is a little risky, especially with today's interest rates. But you're investing with a smart sponsor with a great track record, you'll probably be in good hands.
Yeah, yeah. I couldn't agree more. We allocate sponsor first. We don't care. Like you can have the best deal, the best corner, the best market, the best everything, but if you don't have the right sponsor, it's probably gonna go wrong.
Exactly. Exactly.
What's the best piece of career advice that you've received that made you become as successful as you are today?
Never give up. Never give up. A no doesn't mean a no. If I would have thought a no meant a no, I would be nowhere today. Recently, I asked somebody to hop on a call with me. I wanted to discuss big guy, and he's like, "No, I'm not available." So there's two ways to take that. You could say, "Oh, he's not available." Like, okay, I'll just give up. Or like I said to him, I said, "Hey, totally understand. You're probably busy with a lot of the projects that you're doing. Can I circle back in May? Let's have." He's like, "Yeah, happy to hop on a call in May." So the idea is that's just like a perfect example. Like it's two ways to interpret that. But also just on top of that, I never give up. And I have people, some very prominent guys said to me, Isaac, I've never met a more persistent guy than you. And again, persistent doesn't mean sending a message to John Smith every day for the next 365 days, question mark, why didn't we get on a call yet? Question mark. He'll just never answer you. But persistent can mean in a smart way, persistent but not annoying. So think about it this way. I'm trying to go for your business. I'm out and you say, "Hey, Isaac, I'm busy, this and that." I follow up. Isaac, I don't have time for this right now. So if I just message you 2 weeks later and say, "Hey, question mark, when can we talk?" Now I became a pest to you. But if I message you, let's say, where do you live? I'm at
Miami.
Miami. So I say, I'm in Miami next week. Can we meet for lunch? That's a way of following up without being persistent and annoying. It's being persistent but not annoying. I'm in Miami. I'm not just asking you, let's just get on a call. I'm in Miami. Let's meet. Right? It just I think I coined it like creatively persistent, something like that. So that's something that I've learned a lot. Never ever give up. People like persistence. People like to see that you're actually devoted to your craft. Always be willing to learn and be humble and honest. I have a lot of emails in my inbox from people saying, "Hey, Isaac, send me the DocuSign." And I said, "Hey, after further review, I don't think it makes sense for you to do this." And they're like, "Wow, like you had a commission at your fingertips and you said no to it because you wanted to be honest." So be honest, um, be consistent and reliable. But again, a no is not a no. A no might be a no for now, but a no is not a no. Be creatively persistent. You do these things with a big dose of help from above. I think you could do well.
I really appreciate how much you've mentioned God and Judaism principles and how you feel about, like, I can see how much it's influenced. How do you feel, how do you feel it's influenced you? How do you apply Judaism to your everyday? How has it helped you become, or how has your community helped you today?
Absolutely. So I think that it goes for many, many religions. It could go for Christianity and Judaism and Islam, and just the principles of just being kind, being humble and kind. I think there's a song for that. So just being humble and kind, and honest, and knowing that ultimately I could do whatever I can. I can put in. LeBron James always says is that if I put in every ounce of effort on the floor, the results are not up to me. Meaning to say, if I didn't sleep the night before because I was watching a movie late or doing something, hanging out with friends, then it's my fault that I didn't get good results on the floor. But if I went to sleep on time, woke up early, worked out in the gym, and I was prepared, but I ended up losing, the results are not up to me. So it's the same idea. I'm a big believer. I could do whatever I could do. And I've seen it time and time again. The guys that I think are going to sign don't sign. The guys I think that are not going to sign do sign. I could put in all my effort in the world. If God doesn't want it to happen, it's not going to happen. I'm a big believer of that. But I think that it's important to do your part in terms of being honest. Like, I don't believe that if I steal a deal, ultimately I'm going to make more money. I'll just end up losing out a different deal that I was supposed to get, but God took it away. Meaning to say that I'm going to get what I'm supposed to get. There's a famous story. I love this story of a guy that ran to a post office, and he ran into the post office and all the packages are sitting there that were just delivered, and he grabs the package. He runs home. He hopes, I don't know, maybe there's some money and jewelry or iPads in there, and he sees that that package was made out to him. That was his package. He stole his own package. God doesn't make you get whatever you deserve. It was his package anyways. You didn't get anything extra. And I believe that. And thank God, I think it's the way I was brought up. The people I hung around and the schools that I went to taught me these principles that, and again, it's not specifically Judaism. I believe that the whole world, people of the world believe that there's some basic fundamentals in life. I can do whatever I can do, but I can't control the outcome. You know what I mean? You could have the perfect shot from three to win the championship, right? The perfect shot, literally. We all know it. We've been there. We've been on the court. It goes in and out. There's no reason why that one went in and out and the other one went swish. Perfect, perfect shot. The result's not up to me. I believe that, and I live with that every single day. That's it. That's what I do.
Isaac, you've shared so much wisdom today, not just about cost seg, mindset, connection. Now we talk about religion and building something bigger than yourself. So for anybody that wants to learn more from you, what is the best way to reach you or join Tuesday Connections?
LinkedIn is where I'm at. Very, very active there, but obviously definitely connect with me, call me, email me at iweinberger at Madison Specs. I would love to chat with you about your personal situation, help you out. Yeah,
And this,
absolutely.
this episode is going to be called Have the Conversation.
I love it, man. I love it.
Thank you for being here.
Ahmad, thank you.
Of course.